Hello, fellow traders. 'Tis I, the Rumpled One. Today's topic: daily Wick zone statistics. Those of you who've been following my post this year in the year 2014 know that I came up with a new strategy method that I call the daily Wick zone. And you've probably seen my post out on different forums showing the daily Wick zone, where the daily Wick zone is the area between um, the previous day's candle body top and high and previous day's candle body low and the candle body's bottom and the previous day's low. So if I switch from H1 over to D1, we can see it here where the upper wick zone is from here to here and the lower wick zone is from here to here. It's kind of hard to see these numbers because it was such a compressed candle. But if I switch back to H1 and expand the chart, we can see it. And then this, in other words, yesterday's low, yesterday's open, which would be the candle body's bottom, because yesterday was a green candle, and that's why these two zones are green, to let you know. And then here is the yesterday's closing price and yesterday's high price. Now, there was a trader that asked a question about, he said something about, the 2% of the time, or those two trades that don't work out could just really kill you and take all your profits. And I just kind of had to smile to myself when I read that, because it's obvious that from the comment that rather than try to learn the system, understand the system, analyze the system, and see the value in the system, they just want to throw an offhand comment like that and tell you, just say, poo-poo on it. So what I was going to do was I was going to write an indicator to show what happens when the price breaks out of the top and breaks out of the bottom, out of the top of the top zone and bottom of the bottom zone. And I'd actually written an indicator back in 2010 that shows that, but I had to modify it slightly. So here we have frequency distributions, and in this case, higher high, higher low. In other words, a breakout. And I also have an indicator that puts a blue dot at the previous candle's high and a red dot at the previous candle's low. And in this particular case, this indicator, you can use the breakout of more than one bar. So you could say, well, the last 2 bars, or the last 3, or last 4. But what we just want to look at the previous day, so we've got the break set to 1. And we're going to use 100 bars, the last 100 days worth of data. And as you can see from the frequency distributions, it says we have 100 bars and we had 45 high breaks. Once again, for the low breaks, we had 100 bars and 49 low breaks. If you look at right here, this particular day didn't break out at a high or low, but the very next day it broke out on the high side and the low side. Most days you're only going to get a break one way or the other, but here's another day where it was a slight break to the upside. And here's another day. And here's another day where it just barely penetrated it, but not, maybe just a pip or two. But if you look at the range, in other words, what this range is basically the length of the wick from this point up. So in other words, how far did it go above the previous day's high? Right here. So you can see Here, 1 to 2 bars out of last 100, or 1 to 2 pips, only 2 times. 3 to 4, 3 times. 5 to 9, 6 times. So you can see here, you can get 5 pips or more about 89, almost 90% of the time, based on statistics. It's not probabilities, it's statistics. So it's obvious that this trade is profitable, because if you had taken this trade, each one of these breaks, you would have had 45 plus 49, 94 trades over the last 100 days, and maybe only a couple of them wouldn't have been profitable. So let's just say if you wanted to be a really tight trader and said, okay, I don't want to lose more than 5 pips, or say you don't want to lose more than 10 pips. Let's use 5, really tight. So you put the trade on, and you either win 5 and say, you know what, I want a 2-to-1 risk-reward ratio. So you can see here, you're going to get your 10 pips, about 75% of the time. So if you win 10, 75%, and you lose 5, 25%, you're going to come out ahead. And that's just one way you can use this frequency distribution data. Now, of course, in actual trading, it could go up 9 pips and then reverse, and you could stop out. That's always a possibility too. But if you just want to look at the numbers, that's what the numbers are telling you, that this is a profitable trade. And so for the 1 or 2 times that it doesn't work out, well, that's what your stop loss is for. And to me, most of the systems that I design have the stop loss built in as a reversed trade signal. For example, if price enters the zone and you're looking to go long, well, if price exits the zone, you should be looking to go short. There's your stop right there. To me, it's obvious. So if you're going long, and if price reverses and comes here, well, right here, if price gets in the Wick zone, it wants to come out one way or the other, either to the upside or the downside. And if you want to go long and all of a sudden it drops down to here, well, since it's telling you to go short, the least you should do is exit the trade. So my fellow traders, once again, the frequency distribution here of the break, in pips, shows you that this is a profitable trade. And as always, it's not what you trade, it's how you trade it. And I hope your next trade is profitable. The Rumpled One, signing off.